Welcome to Protocol. I'm your host, Ryan Moon. This week, everyone was talking about Bitcoin clearing $72,000 and a massive short squeeze. But that price move is actually the least interesting thing that happened. Today, we're getting into the one paragraph buried inside a Senate bill that set the whole thing in motion, and the ethics clause nobody wants to name out loud. Bitcoin jumped 12% in 2 days this week, cleared $72,000, and roughly $2.7 billion in short positions got liquidated in the squeeze. And every headline told you the same thing: the crypto bill is back from the dead. Here is what nobody told you: the price move is the least interesting thing that happened. The story is a single drafted paragraph in a Senate bill, and it explains everything. The bill is the Clarity Act, digital asset market clarity. It is the market structure law that would finally split crypto oversight between the SEC and the CFTC, which is the referee question crypto has been screaming about for years. Is a token a security or a commodity? The House passed it last summer, and then it went to the Senate and sat there for more than a year, hung up on exactly two things. One of them is buried so deep in the text that most of the coverage never named it. That is the one worth your time. Section 404. The title is, and I am quoting the drafted text, prohibiting interest and yield on payment stablecoins. What it does is deceptively simple. It bans any crypto firm from paying you interest or yield solely for holding a stablecoin. If your dollars just sit in the stablecoin, doing nothing, you get nothing. Because in the eyes of this bill, that would make the stablecoin behave like a bank deposit. And banks have opinions about things that behave like bank deposits. So why did this one paragraph unlock the whole bill? Because it is a peace treaty with the banking lobby. The banks fought stablecoin yield harder than anything else in the bill on the argument that if Americans can park dollars in a stablecoin and earn yield, that money drains out of bank deposits and bank lending dries up. That was the roadblock. For over a year, the compromise threads a needle. Passive holding yield is banned. But there is a carve-out for rewards tied to, quote, bona fide activities, real usage of crypto platforms and networks. So you cannot earn yield for sitting still. You can earn rewards for doing something. Coinbase's chief legal officer framed it as a win. His words: the banks were able to get more restrictions on rewards, but we protected the ability for Americans to earn rewards based on real usage. The CEO of Helios framed the same outcome a little more honestly. His version: the clarity of not getting risk-free yield on your dollars without using a bank. Same paragraph, two moods. Now here's the part that got skipped entirely. The banking industry's whole case rests on one claim: stablecoin yield drains deposits and starves lending. The White House Council of Economic Advisors ran the numbers on that premise. Banning stablecoin yield would lift US bank lending by about $2.1 billion. That sounds like a lot until you learn it is 0.02% of a $12 trillion market. And the same estimate says the ban costs stablecoin users about $800 million a year in lost rewards. So the entire year-long fight was over a rounding error for the banks and a real bill for everyone else. Those numbers come from a single source, so hold them loosely. But if they are even close, the premise of the opposition contests itself. When Section 404 dropped in early May, real money prediction markets moved. Polymarket odds of the bill getting signed this year jumped to 55%, up 9 points in a day. The committee advanced the bill 15-9, bipartisan, on the 14th of May. This is what go time looks like. And then it died. Sort of. Here's the gap nobody's explaining. Between that committee vote in May and the August recess, the momentum just evaporated. By this week, investors were treating the bill as effectively dead for the year. 3 months from bipartisan committee passage to a corpse, and the roadblock everyone pointed at, the yield fight, was already cleared. So what actually stalled it? The sources don't say, which is precisely the tell. When the named obstacle is gone and the thing still doesn't move, the real obstacle was never the named one. Look at what the president is asking for. His words: pass a fair version of the Clarity Act. Fair version. That is doing enormous work in that sentence. So because there is a second fight, and it is not about yield at all. It is an ethics provision pushed by Democrats that would bar the president and other public officials from personally profiting from crypto. No source will tell you exactly what conduct it bars, which is convenient for everyone. But you can connect the dots. The president's family has significant crypto exposure, and a fair version, in his phrasing, appears to mean a version without that provision. The mechanism-focused coverage buries this. It is the live partisan blocker, and it is treated like weather. There is a second technical fight too, and it has real bodies attached to it. Title 3. The question is whether a person who writes non-custodial software, code that never touches your money, gets classified as a money transmitter and slapped with bank-level know your customer rules. This is not academic. Last summer, the developer behind Tornado Cash was convicted of conspiracy to operate an unlicensed money transmitter for writing code. Title 3, through a section called 604, is supposed to say that non-controlling developers of non-custodial software are not financial institutions. Senator Lummis calls it the strongest protection for developers ever enacted. A crypto lawyer named Jake Chavinsky says the money transmitter misclassification is, quote, still unsettled, and the changes Lummis is touting have not been publicly released. So the strongest protection ever enacted is, at the moment, a claim about a document nobody outside the room has read. Here's the thing that makes all of this feel a little theatrical. Even if the bill dies on the 15th of September, the SEC-CFTC split might happen anyway. The CFTC chair has already signaled a willingness to move forward on crypto regulation if clarity fails, which means the entire negotiated compromise, the yield treaty, the developer protections, the ethics fight, could get bypassed by a single agency deciding to act on its own. A negotiated law and a unilateral agency decision are very different animals. One has the developer carve-out written into statute. The other has whatever the agency feels like that week. So back to where we started. How did a 12% Bitcoin move and 2.7 billion in liquidations become the headline, when the actual story is one paragraph and one buried ethics clause? The answer is that the price is the easy thing to photograph. Short squeeze makes a chart. Section 404 does not make a chart. But the chart is downstream. Traders piled in because the White House hosted crypto CEOs and everyone smelled a vote coming. The vote is coming because a banking compromise got drafted in May. The compromise matters because it redefines what a dollar in a stablecoin is legally allowed to earn just for existing. Watch the 15th of September. If it passes, the entire stablecoin industry pivots overnight from advertising yield to engineering usage. And every product team in crypto starts asking the same question. What is the smallest amount of bona fide activity that unlocks the reward? Nobody has defined that line yet, which means somebody's going to spend the next year gaming it. And if it fails, watch the CFTC, because the referee question gets answered anyway, just by one referee instead of two, and without a single word of that developer protection anyone spent the last year fighting over. Thanks for listening to Protocol. I'm Ryan Moon. We'll be back with more Mechanism First crypto news. See you next time.
Grab news. Thomas.